Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello, and welcome to another episode of Dividend Discussion here on Dividend Obsession. I'm your humble host, Troy, and today I have the pleasure of speaking with Twitter legend Dividend Dave from the Passive Income Podcast. Dave, if you wouldn't mind giving yourself a brief introduction and telling the people who you are, where you're from, and if you want to share your age so they can relate.
So a legend in my own mind, I guess.
That's all that counts. That's all that matters.
Right? Yeah. So definitely not really a Twitter legend, but I do appreciate the whole Twitter community, the Div Twit and Fin Twit communities, and all of my followers. I do appreciate every single one of them. As you mentioned, I'm also the host of the Passive Income podcast on YouTube, and we just surpassed episode 90 yesterday or the day before, and so yeah, closing in on 100 different guests, 100 different people, 100 different stories, paths, journeys, and it's just been absolutely incredible to talk to every one of those people, including yourself, Troy. I believe you were episode 48. If I did look it up, and I'm quite sure you were episode 48, and so um, that's been amazing. I'm in Canada, as most people know. I'm just on the North Shore, the north side of Lake Ontario, in that sort of central to eastern Ontario part of geography, about 2 hours driving time east of Toronto, to just give a relation. And yeah, I'm 50 years old. As most people know, my Twitter handle is at Lovey 1973. So the 73 represents my year of birth. It's like I can't believe 50 years. Like back in May, we did a live stream on my birthday, and I had, I think, 9 people, or myself and 8 other people, on the screen at one time through the episode, and it was just so much fun because we looked like the Brady Bunch or Hollywood Squares, if anybody's old enough to remember those references to the 9 squares around the screen. So yeah, that's kind of me in a nutshell, and I guess let's just get into wherever this conversation takes us.
Yeah, I appreciate that, and for those that you don't know, Dave, I interviewed with Dave, like he said, forever ago, and doing that interview is really what inspired me to do this, because I was just like, man, like finding out the lessons learned from other people is a great way for you to make sure that you're not making the same mistakes. So it was really cool. I learned a lot from Dave's interview. Dave's a natural at this, way better than I am. I have a lot of fumbles and stuff, but that's all right. So. All right, Dave. So first question is, when did you begin your investing journey, and what got you into dividend investing specifically?
Oh wow, so that's a that's quite the question, because it's a long answer. So I hope you have a
Oh yeah, we got
coffee or
time.
something.
We got time.
Yeah, sit back, relax. So this goes back to the late 1980s, early 1990s, when I was around 19 years old, and I read a book called The Wealthy Barber by Mr. David Chilton, and it's still a very popular book. It's a little more Canadian centric, but it still rings true no matter what country in the world you may live in. The very first lesson I learned in that book, and still to this day, it was the concept of pay yourself first. So out of every paycheck, pay yourself first, whether it's 10%, $25, $50, whatever it happens to be, out of every single paycheck. And so now you have to keep in mind, in 1990, we did not have things like the internet, and we did not have cell phones. So we definitely did not have apps on our cell phones. There was no social media. There was none of that. I do recall calling a stockbroker, and I can't even remember how I found that number, because, again, this is going back to you looking it up in the yellow pages, right? Like, and so, that conversation did not go well at all, because the stockbroker was like, "Oh, you need $10,000 to invest," and I'm a 19-year-old kid. I don't have an extra 10 grand lying around. And so, then I finally found a financial advisor who was willing to take me on, and so I started with mutual funds.
Mhm,
And at the time, I know you can obviously argue the pros and cons of mutual funds all day long, but at the time that was kind of what was available.
mhm,
The stock market was sort of out of reach. Fractional shares were definitely not a thing. And so I recall I needed $100 to start the mutual fund, but then after that I could put in whatever amount per month, whether it's 25, 50, $100. And I recall I started with $75 per month after that initial $100 investment. And I did that religiously for a good 5 or 6 years, from the age of 19 to the age of 24 or 25. And I'd started to build up this nice little nest egg for someone so young, right? And then I made the biggest financial mistake of my life
mm,
because, at 25, you know, you're an adult and life starts to throw you some curveballs,
mhm,
as life does. And all of a sudden it was like, okay, well, I can just take 10 grand, or I can just take 2 grand out of that. Oh, I can just take another grand out of that. Oh, I can just take another 2 or 3 grand out of that. And then suddenly this little bit that I had of, I forget what the max was at the time, maybe 10, 12 grand. But suddenly that had disappeared to 0, and so, by the time I'm now 26 or 27, I have 0 investments for the future, and I'm right back to square one where so, yeah, I still kick myself every day for that. If I still had that mutual fund, after 30 plus years, it would be it would be a lot of money,
mhm.
like, right?
Yeah.
So, yeah. So that's the mistake that your younger viewers definitely don't wanna make is you need to find a way to not touch that money.
Mhm,
That's the really one of the hardest things to do, especially at that age when, like I said, life starts throwing you curveballs and you need money. You need to find a way to take care of things. And yeah, just figure out another way, do something else. And I think that's maybe another part. These days, side hustle culture is huge.
mhm.
So you can find ways to do it. You can find ways to maybe sell something on marketplace, or do some type of side hustle that you don't have to touch that investment, right? So that that's part one of my answer to your question.
Yeah. Well, I mean, I think I always like to hear the stories of people. So first of all, thank you for sharing that, and then two, I like to see the lesson that you learned and like what we can all take out of that. Because like just hearing a story from somebody that made a mistake doesn't matter really unless you take the gist of it and
Right.
learn how to apply that to yourself. So I think the takeaway of that is that you started young, like you found your avenue that you could get started investing, and
Right.
then you got into the investments and you understood that it was a savings account for the future, but you thought the future was at 25 and not at 55 or 65,
Yeah.
and
Well,
like
kind of like, obviously it's the life throws you curveballs. It was the big thing, right? So
yeah, yeah. And I mean, yeah, like you said, there's always another way other than for lack of better terms, screwing your future self over. There's always
right.
another way to find that money. And what often happens is we do take that path of least resistance, where we have all this money sitting here. I can just do this, and I don't know. Some of those have like early terminate, not termination fees, but like early withdrawal fees. You have to pay taxes on this, or I know we have that
Right.
with the 401k here, where you have access to that money early if you need it. And there's certain stipulations where some of the taxes and fees get waived, but in most cases there's early, like taking it out early fees. There's taxes on it and all kinds of stuff. So always try to find another way to not
Yeah.
ruin future Dave, or ruin future Troy, or ruin future whoever's watching.
Yeah.
That's important. You'll set yourself back. Um, okay, so I mean that you said you got into mutual funds. Did that mutual fund pay a dividend, or did you get into dividends after that by accident? Because that's how most people I've talked to so far, they seem to discover them by accident.
I know. So yeah, obviously, again, going back to the 90s, things were very different. So it was just a mutual fund that obviously had a basket of companies within that fund. And So if they paid a dividend, they would have remained within the fund, right? So not like paying it out to a brokerage account the way we see now with an app on our phone where it's just cash shows up into your account and you can reinvest that, or you can have an automatic drip set up or whatever.
Mhm.
Um, but I guess just part two of an answer to your initial question, fast forwarding into the 2000s, and now we do have things like the internet and online banking, and the banks are beginning to offer online trading within their banking platforms. And so suddenly, now you also have to keep in mind that at the beginning, the commissions were 29.95 per trade, $30 per trade. So that's a buy or a sell. So to make a profit, you have to be up $60 on a stock, um, which obviously can happen. It does happen, but it's also just as easy to lose money in the stock market.
Mhm.
And so, yeah, I was trying to dabble a little bit, but it's again very hard. At this time, I'm, I guess, into my early 30s, and yeah, it becomes very hard. And I just couldn't really justify that 29.95 uh, commission. It was incredibly high, right? Incredibly high. But I did manage to kind of get some, stocks here and there. And, then the 2008 financial crisis came along, and, you know, stocks dropped, and it was like, this is a great buying opportunity. So I was able to pick up a few more. And by this time too, a lot of the commissions had dropped from 29.95 down to 9.95, which is still by today's standards
Yeah.
extremely steep, right?
Yeah.
But it was like, oh wow, okay, this is a little bit of a game. It's not a total game changer, but it does change the game a little bit. And so yeah, through that era, I was able to kind of buy and sell and make a little bit of profit here and there. Um, but again, it wasn't really enough to set up future Dave. And again, now I'm looking back 15, 20 years, it's like, oh man,
Yeah.
it seems like another mistake I made, right?
Yeah.
Because at that time, probably by the end of 2011 or 12, I had sold everything off, and like I said, I kind of did okay. I made some profits, but and I can't remember if any of those were dividend payers or not. I honestly I don't think so. I think I was playing a lot in the oil and gas at the time because oil was very low, and well, everything was low after in 2008 and 9, right? So kind of once I saw those profits in 2010, 2011, 2012, I just took the profits basically. Um, and then I got married. Well, I got married in 2013, and my marriage only lasted 7 years till 2020. Um, and her and I definitely had a very different view on investing because every time I had, money put into a TFSA, which is a tax-free savings account here in Canada, or an RRSP, which is another type of savings vehicle here in Canada. Every time I'd have any amount of cash built up in those accounts, she would say, "Oh, well, let's buy this, let's buy that, let's buy this, let's buy that." And I would say no, and she would say yes, and I would say no, and then eventually I would cave. And so again, by the end of my marriage, I had next to nothing in any of those accounts. So it really is only since 2020 that I've really dug into the dividend strategy. And through this whole marriage too, like I had kind of discovered the dividend investing strategy of okay, buying shares, accumulating positions, reinvesting those dividends, and over time, with both with both like the dividend return as part of your total return, but also the idea of having capital appreciation over time in these companies that after 15, 20 years you're going to be hopefully in a really good position, right? And I tried to explain the dividend investing strategy to her so many times, but I really know that all she saw was like, the 5 cents or the 9 cents of that first dividend
Mhm.
purchase, and not the long term vision of, well, that 5 cents turns into 25, turns into 50 cents, turns into $1, turns into $10, turns into $100, and more, right? So, um, luckily, in 2020, through the divorce, and it was a very amicable divorce. Her and I are actually still friends. I still text her pictures of the dog and all that, and I still just a few weeks ago or a month ago, her lawnmower died. So I took my lawnmower over for just a push mower for her to mow her lawn. So like her and I are still good. I'm getting a little sidetracked there. Sorry. But
No. That's it.
so anyways, when we sold the house, I was able to make a pretty good chunk of change because again, real estate kind of went crazy in the late 20 teens, right? And so I right away I was like, okay, um, I'm going to take a good chunk of this and put it right into you know dividend paying stocks. And off the hop, I focused on a lot of REITs because here in Canada, REITs pay a monthly dividend, and I was really focused on building that return faster or as fast as possible. And right now, I'm kind of getting hammered on the REITs because of the high interest rates.
Mhm.
However, I still believe in them long term. So, like, I mean, they're physical. They own physical real estate. The buildings aren't going to fall down. They still have tenants. They still get paid.
Yep. And in the
Uh,
meantime, you're making money.
yeah, like exactly. Like, sure, the actual stock price has been hammered down, but they're still paying that dividend. A couple of them have hit me with dividend cuts, but in the long run, in 10 years' time, I'm not gonna fret over those dividend cuts that happened in 2022 or early 23, right?
Yep.
So, and then I also through that 2020 2021 time frame was of course the crypto craze. So I got into a bit of crypto, probably more than I should have, and I do still own a little bit of different cryptocurrencies here and there, but of course I did lose a significant chunk in a cryptocurrency staking scam, which of course I kick myself to this day because if I had that money back in my dividend portfolio, I'd be making I'd be making returns on it through the dividend every month or every quarter. But yeah, so that's sort of the part one, part two, and part three answer to your original question.
No, I appreciate that because like it is there's a lot of layers to it, which is good. There's a lot of lessons that you actually learn. Now, like the thing that stinks is at like in life you either have time, money, or wisdom, and it's kind of like a slider system where you
Yeah,
you never have full sliders on any of them. The more wise you get, the less time you have. Often the older you get, the more money you have because you've had time to let it do its thing. It would just be amazing as if we were 18 and like if once you hit a certain age, you could just flash back to 18-year-old self and be like, hey, look, I've been there, I've done it. Don't do this and do
yeah,
this. Like that would be really cool. But fact is, in at least in 2023, we don't have that technology yet, so we can't do that. So you've learned those lessons, and that's like the big point of your show and the big point of my show is just like being vulnerable to put yourself out there just in hopes that even if there's one person that watches that can be like, hey, I'm in that same situation. Dave said that he did this and he wishes he would have done this. Now I can do that.
right. Yeah,
Because they always say that you have to learn from mistakes, but nobody said that they need to be your mistakes.
yeah,
Like
that's a
I don't
great
need to
point.
learn from my own mistakes if I can learn from what you did.
Yeah,
So
that's a great point.
yeah, so like if you can do that, and learning from your mistakes cost me a lot less money. So that's always a win right there. If I can learn from like let you pay the money for it, just like somebody before you learned a mistake, and then whether we just went through a thing where you told us about all the things that you made mistakes on.
Right.
But there's been plenty of things that you've done right because you've learned from somebody else as well. So that's
Yeah,
really
that's another point.
go ahead.
Sorry to interrupt. That's another point I was going to make about all of the guests I've had on the Passive Income podcast. Not just learning from mistakes, but also learning from and celebrating so many successes as
Yep.
well. Right. So many great people have come on with incredible success stories of financial independence, retire early. People retiring at under the age of 40, people retiring at 40, 45, 50, and those are incredible inspirational stories as well. Or other guests who have come on who aren't retired yet, but they're like, yeah, I'm making 60, 70 grand a year just in dividends. And you're like, oh, wow, you're making that much in dividends. Plus you're still working a job
Yeah.
and still investing more so you can make even more dividends
Yeah.
and again, at the same time, you're hoping for capital appreciation because it can't all be just about the dividends,
Mhm.
right?
Yeah. Yeah, that's very true. So I mean, you kind of answered this question, but if you have anything else you want to add to it, like what do you have a biggest, like, if you could narrow it down to one biggest dividend related mistake that you made and like the lesson that you actually took away from it for like the people that are watching?
Yeah, so probably like I said right off the when I kind of started a few years ago into really focusing on the REITs, probably understanding dividend yield better, and the difference between dividend growth and dividend yield. When you see a REIT at 9% yield, and you're like, "Hey, wow, that's a juicy yield."
Hmm.
But you don't understand. Oh, but there's this other one that's in that 3 to 5% yield range, but they've actually been growing their dividend every year for whether it's 10, 15, 20, 50 years or whatever, right?
Hmm.
So I've definitely learned that dividend growth is probably more important than dividend yield.
Yeah, and it matters a lot for the time frame that you're in too. Because I don't like this, age really doesn't matter to me when you do dividends, because like you could have, and that's why like the demographics of the YouTube channel really don't matter, because like I could have a 40-year-old that's watching me and they just heard about dividends yesterday, or you could have a 40-year-old that's been doing it for 20 years. Like
Right.
the so that doesn't mean anything. And then like the yield, if you wanted to go for higher yield and possibly lower, like you don't really want to go for, capital depreciation. That's never the goal. But like the higher yield, lower growth, you could do that if you're already retired and you need the income. But if you are at your point, at my point, where you're just trying to grow your portfolio, sacrificing a little bit of that yield for the growth is a really good realization. I've seen so many people that are, you know, 20, 21, 22 years old and their portfolio has like a 16% yield. And I'm just like, I mean, no matter how many times they watch a show like yours or a show like mine or read it on the internet that like don't chase yield and like be smart with your decisions and stuff like that, sometimes you do have to make the mistake on your own. Sometimes that's the
Right.
best way to learn, is for
Yeah.
you to lose your own money. So that's really cool that you were able to look at that, because I know a lot of people expect, like on Twitter and on Facebook, even on Reddit, I see a lot of people where they post the underlying goal of trying to find those highest yielding stocks, and I'm just like, okay, like the questions I have for you is like, when do you need the money? Because it looks real cool for you to make two, three, $400 a month in dividends now, but like if you don't need that money until 30 years from now, I'd rather
Right.
see you make $50 in dividends and then make $100,000 a year in dividends when you need it. Like it doesn't
Yeah.
matter what you make today. Yeah, it helps you compound a little bit, but like in the long haul, like that's the other thing that's very hard about dividend investing, is like you were saying about your ex-wife, is like getting some people to understand the and
The
see the
long
pot.
term.
Yeah, it's a long journey. You have to see the pot at the end of the rainbow and like understand that there's a bunch of steps you need to take today that might not seem like
Yeah.
big steps, but they get you to the goal at the end.
Yeah.
And that's
Yeah.
very hard to,
Because
like, I try to do that at the gym. And anytime I talk to anybody about dividends, and like, they'll give me oh, it must be nice to make that 52 cents or whatever. I'm like, yeah, but 30 years from now,
yeah.
or not even 30, I have a 22-year time horizon. And 22 years from now, when they're still working and I'm sitting back with my feet up, and they're like, oh, must be nice to not have to work at 50 years old.
Yeah.
I'm like, yeah, remember that 52 cents? That's what's doing it for me. So,
Yeah.
um,
Exactly. Right.
yeah,
And that is a very that's exactly the point I was making. Is so many people just look at that initial, like I said, 5 or 10 cents, and like you said, 50 some cents, where if that's all you're looking at,
mhm.
you don't have the vision.
Yeah,
You
you're
need
doing
the
it
long
wrong.
term.
Which is
You need the
weird
long
too,
term.
because like the house that I'm recording in, we had it built in 2018, and while we were having it built, they like we have to do like periodic like inspection checks where we walk in and like they tell us whatever. And
Hmm.
what was weird is like I walked in the house when it was just like a bunch of studs and stuff. And they were like, over here's your living room, over here's the bedroom. I was like, guys, I don't see
Yeah, I don't
nothing.
see it.
I see a bunch of sticks is what I see. And then
Yeah,
then I get into dividend investing and I do the same exact thing. I'm like, over here's gonna be a thing that's gonna pay you $10,000 a month, and over here's gonna pay you this. And I'm asking them to see see the house within the studs
see
more
the
or less.
finished living room
Yeah.
as opposed to just the framing.
Yeah, just the drywall and electrical, or what, not even, we didn't have drywall. It was just the framing and electrical, and here's like some pipes sticking out of the ground for where your
Yeah,
sink's gonna be and stuff like that. So it's kind of like that with dividend investing, where you're walking in when the house, like sometimes when you first start, you're just looking at the land. Like there's not a
Yeah,
foundation on there. You don't have a driveway. Like you probably went over a bunch of rocks to get there, like all kinds of stuff. And then eventually the
that's a great
foundation.
analogy. I'm going to steal this
Yeah.
from you
Yeah.
because yeah, you're 100% right. Like you look at a vacant piece of land and it's just a field
Yeah.
or whatever it happens to be.
Yeah.
You start digging around, you have to dig up, pour footings,
Yep.
pour a foundation.
Yep.
Yeah, and then you can't put the roof on first. I've said
Yeah.
that for years. You can't put the roof on the house before you pour the foundation.
Yeah. Well, a lot of people and other people try to like pick out the furnishings before the house. You don't even have the land picked yet. They're just like, what color do we want the doorknobs to be? I'm like, I don't care about we don't care about the doorknobs. We're
that
working
doorknob
on
decision is a long way away when you're just looking at a field, right?
And that's the same thing with when you get your dividend portfolio. Like if you're like, okay, like my portfolio yields at like 2.5%, but I might need a little bit more money. Now's when you're picking your doorknobs. Maybe you transition or any new money you add is into a 4% yielder to get your portfolio average up or whatever it might be. And that's your finishing touches. What color do you want the curtains to be? All kinds of stuff like that. So yeah, that's I don't know. I just thought of that. So there you go. Feel free to take that.
No, because you can use that analogy right through the entire build of the house, right?
Yep. Yep.
So
yeah, building your portfolio, figuring out, learning the lessons from the stocks that you did buy, and like the ones that are, I try to do that with my portfolio is like the ones that didn't work. I don't just say, oh, that didn't work. Like, why didn't it work? Like, what did I identify when I bought that stock? And then like, what does it look like now? Like, what should I have seen? And sometimes there's nothing to see, like something random happened and whatever. But like in most cases, you can be like, okay, I bought this because of this, but I ended up wanting to sell it or needing to sell it because of this. Was that something I could have identified when I bought it? And how could I have done that? And same thing with your winners and that's probably arguably more important is identifying, okay, I bought this stock for this reason. What is making it do well? Is it because it has a really low payout ratio? Is it because the management's doing well? Is it because of whatever the debt's really low on the company? Like any of those things. And like, I mean, on my channel, I don't dive super deep into like financial statements and stuff like that. Like I keep all my reviews really simple just because like all that other stuff's so complicated to me. But I mean, I put my monthly recaps up there and I'm doing pretty well. It doesn't have to be complicated. It just has to be what you understand.
Actually,
okay. So
this morning,
do what?
Just this morning, I was looking through my entire portfolio, like clicking on every single position and seeing where I was up and down. And yeah, so I was actually thinking I want to put that into an Excel spreadsheet and just kind of track my winners and losers a little more closely.
Yeah, well, that's actually what I'm glad you said that because I was going to bring that up before. One of the most important things that I stress the most is tracking your progress on dividends because it is a slow journey. So one thing I always say on the channel is in the beginning of the journey, tracking the actual dollars and cents is kind of discouraging because it is so small. Like it's exciting to, oh, I got 17 cents from this company this quarter, and then they pay out next quarter, and I might get 24 cents next quarter. Like I can see that growth. But like what you want to do in the very beginning when you track your stuff is track the percentage growth year over year, May to May, June to June, whatever it is, because that's when the growth, like your percentages are going to be ridiculous. Like you're going to have hundreds of percent growth, maybe even thousands or tens of thousands percent growth because the numbers are so small. And then eventually, as you carry on with your journey, the percentages get smaller. But by the time the percentage gets smaller, you're going to notice that you're making $120 a month in dividends. And you're like, oh, that can pay my cell phone bill and a week of groceries or something like that. And like you can start to relay it like that. And then the numbers get exciting because then the numbers start to compound and $120 turns into $150 the next time or whatever. So it's a lot more. It's just important to track that stuff because like Dave and I say, like dividend investing isn't for, you're not going to see it advertised on TikTok where this guy's going to drive a Lamborghini. He's like, I just started dividend investing 3 weeks ago and now I'm rich or whatever. That doesn't
definitely
work like that.
Does not work like that.
Yeah,
I've said in the past, it's probably possibly the greatest get rich slow scheme going.
Yeah. Yeah. I've said that in a couple, I've maybe even with in the interview with Jeremy, I was like, it almost seems like dividend investing's a scam. Like when you tell somebody about it, you're just like, okay, I'm going to own a high quality company. They're going to work really hard for me. They're going to make more money and give me money. And I'm going to put that money back in. And then they're going to give me more money the next time. And then I'm going to put that money back in. And you're
I,
just
I
like,
re-
okay, like did anybody have a marker? Where's the pyramid scheme? Like,
yeah,
how's this doing? Like, what are we doing here? But
I
yeah, it's
refer to
legit.
that as the opposite of the vicious, like the vicious cycle is the exact opposite. It's
Yeah.
like the happy
Yeah,
cycle.
it's the pleasant cycle of dividend investing.
Yeah.
There it is. Yeah, it's pretty cool. So, that being said, what are your do you have any short term and or long term goals that you hope to achieve with dividends? Like, do you have anything that you're hoping to get to by the end of the year, and then like what you want to do by the end of the end of your dividend journey?
Yeah, so I'm going to answer that question by kind of topping off the last topic of tracking dividends. I do have an Excel spreadsheet where I do track every single dividend that comes in every month and every quarter, and I do have that set up in sheets so that a couple sheets over, I have like year over year growth showing from um, I think just 2022 up until 2031, so a 10-year time frame. And I've posted screenshots of it on Twitter a few times, so you can see the growth beginning to happen, right?
Mm-hmm.
So the short term goals are really just stacking shares in a number of companies. Since the beginning of this year, the two companies I've been focusing on the most dollar cost averaging in, and there's another important thing we should talk about is dollar cost averaging.
Mm-hmm.
Bell Canada, which is the largest telecom provider in Canada, and of course these days they're not just it's not just landlines and cell phones. They're a media company as well. They
Mm-hmm.
own um, like uh, they own a lot of media as well, basically, and internet, obviously. So that whole bundle. And then Bank of Nova Scotia, another one of the big 5 or 6 strong Canadian banks. So those are the two, and Hydro One a little bit too. I've been trying to get Hydro One is the biggest supplier of electricity in Ontario, and something like 95 or 97% of Ontarians get their hydro from Hydro One. So those are the three I've kind of been trying to focus on this year, and just building larger positions. And this kind of also goes back to the dividend growth, where Bell and well, they're all kind of right now yearly growing their dividends. Hopefully that continues. So those are the three I've been focusing on. What quite often what I do, because Bell right now trades at it's just under $60. It's been hovering in that 58 to 63. I'm obviously talking Canadian dollars.
Mm-hmm.
Um, and Bank of Nova Scotia is a little higher at 66, 65 range. I do believe these also do trade on in New York in US dollars too. So Americans have access to investing in these great Canadian companies as well. Um, so yeah, those are the three that I've been trying to like just build positions on. But quite often, what I do is like, okay, say I have 300 from from pay myself first day, plus maybe I have another 100 from dividends, so I have 400 in there, and I'm like, okay, well, 60 something times 3 or 4, that's a good chunk of that. And then I just have a few other like less expensive ones where I'm like, okay, well, like if it's $4 and pays a 2-cent dividend, I'm like, okay, I've got $4 left in my brokerage account after these other buys. I'll buy one more share of that because I'll take the 2 cents every month or whatever,
Yeah.
right? Like,
Yeah. So do you guys not have or like with Fidelity right now, my cash position is I think it's SPAXX, and because the interest rates are being raised by our Fed, like the interest I get on that, it's a 7-day yield of 4.75%, which is higher than my portfolio is. So I actually moved my emergency fund into that, and I keep 5 months worth of expenses in that, and I don't touch
right,
it. And then anything over that every month I invest. But I was like, why wouldn't I get like I just keep money, and now my approach is I dollar cost average every day. So I put however much money I'm going to put in for the month, put it in, around the first. I pay the mortgage, see what the bills are, then I subtract it out. And
hmm,
then I just divide that by my goal allocations. And I just put, $9, $10, $8, whatever keeps me balanced in my portfolio. I just put that in every day. Now, going back to what you were saying earlier, that wouldn't be a possibility 20 years ago with the 9.95 transaction fees. Like I would be like, that would be pointless. Like that's better
right,
for lump sum investing where, hey, taxes came in, I have $1,500. I'm going to put that in there. I'm going to pay my, $9.95, transaction fee and then going about my day. So I think what you were saying about dollar cost averaging, I imagine there's all kinds of studies which I don't agree with and I don't like them, but I mean, if the facts are the facts, where they say that lump sum investing is better than dollar cost averaging. Which I don't know. I just have horrible timing, so I'm just like, I'm gonna buy every day because
Yeah.
it goes up every day. Or it goes down the day after I buy it. So if I buy every day, then I'll get the I'll get the deals too.
Yeah.
But like, I wonder, do you think there's any impact on lump sum being better, quote unquote, better than dollar cost averaging because of those transaction fees? Like, because that's still factored in there. Like, if they go back 40 years, like there was transaction fees.
Right. Yeah. So honestly, I've never really thought about it too much since we now have apps on our phones that you can literally buy and sell for, like commission free.
Yeah.
Definitely, yeah, 20, 30 years ago when you were paying 10 or $30, or even back in the 90s, people would be paying $60 to a stockbroker. And so back then, yeah, you definitely needed to do more lump sums. Obviously, right? Because
Yeah.
like you said, like what you're doing at $9 a day, well, you would be paying $18 a day just to and only seeing benefits from half of that,
Yeah.
right? So
Yeah, yeah. So like that's kind of, yeah. I'm wondering. Like I've looked up because there's a couple videos that I've done on like dollar cost averaging and stuff like that. And I wonder. You got to figure. Robinhood came on the scene, and they're the ones that pretty much barred everybody from doing this. Paying for each transaction, which is for all the slack Robinhood gets, they've done some nice things for everybody. So
right,
but they, I wonder, we really only have what, 10 years worth of like commission free trading, like actual, like pure dollar cost averaging to the point where if I wanted to add $1 a day into Coca-Cola, I could do that and not have to worry about it.
right.
So when you look at these studies versus lump sum versus dollar cost averaging, I wonder how much of an effect, because you have an unlimited amount of time of examples of lump sum investing because it was worth it to do that back in the day, not so much dollar cost average versus
Yeah,
now dollar cost averaging, I think makes more sense because there's no reason to let $4 sit in your account if you can put $4 into Visa or Starbucks or wherever you want to put your money. So,
yeah, exactly.
yeah,
No,
that's
great
interesting.
point.
Okay, so next thing. So I've actually, in one of my interviews, I think it was with Dave, not you, another Dave Maloney, and he was saying that in his investing journey, one thing that he's noticed is that he very rarely regrets his buys, but he always regrets his sells.
Yeah,
So, like he says, even if it was not a good company, he goes, I end up selling more companies that turned into winners than I did selling companies that I should have sold. And I was like, that's a really good way to think about it. Like almost like, okay, I don't have to add more money to this position, but I'm not going to get rid of it. I bought it for a reason. I'm just going to hold on to it and I'm going to turn off the drip, and any money that it gives me, it's just going to be like a more or less like a dormant position. So like, what are your biggest buying brags or selling regrets that you have?
yeah, that's a great point. So, every every second Thursday, when I get that on pay myself first day, and I transfer some money into my brokerage account, and hopefully there's usually some dividends sitting there in cash positions as well. And so, yeah, every time I click buy, I feel good knowing that hey, I've just raised my patty, my projected annual dividend income
Mm-hmm.
by whether it's by 5 cents a month, 10 cents a month, you know 90 cents a quarter, whatever it happens to be, right?
Mm-hmm.
And so, yeah, those buys you feel good about. I'll tell you a selling regret, and this actually circles back to the cryptocurrency loss. I had a very large position in a fund called Canoe EIT.UN, another Canadian um, index fund. I believe it's an index fund technically. And I had over 1,000 shares, and they were paying 10 cents a month dividend. So I was getting over $100 a month in dividends just from that company alone, which obviously is very nice. It was really adding to my portfolio quickly. And I was at one point, the fund reached like an all time high, and I sold the majority. I think almost all thousand. Well, like I said, I had over 1,000, so I think I ended up selling about 1,000 of them. And yeah, that was over a year ago. So that was in early 2022, and I moved way too much of that money into that cryptocurrency staking scam. Because now I look back and go,
Yeah.
well, sure, I sold it at an all-time high and I made well over $1,000 in profit. But 10 months later, at $100 a month, I would have made that same $1,000, and I would have still
Still had your
been
shares.
sitting on it, making $100 or more every month on it
Yeah.
since then. So, yeah, that's definitely a selling regret, big time.
Yeah. Do you have any buying brags, like maybe a company that you identified as a winner when it wasn't, wasn't worth a lot and now you own it and now it's worth a lot?
Uh,
Like did you buy I know you don't own any American companies yet, right?
no,
Like so for example, our example would be like, okay, I bought Apple back in 1999 when it was worth $4 or something like that, and now
right.
it's worth, $180, $190 a share. Do you have any of those?
Definitely not.
Yeah. Well, I mean,
I
the
do
the
have
hard part
one
about
that
that is what you were saying earlier is that you've started and had to restart so many times that like those winners that you identify, while you can do, one that just, you bought it at $10 and 2 years later it's worth $100. That's not the normal. I know it seems like the normal because of what we've been going through recently, but like normal is I bought this company and 20 years later it's now I have thousands of percent gain because I've held it for so long. So you're kind of almost in the same boat I am where like I have some winners. I have winners that are up, 50, 60%, but like nothing crazy yet because I just haven't been doing it for long enough. Like I haven't had enough time to let the tree root and dig its roots real deep to get me those big gains that I'm looking for.
I do have a small position in one company that I'm quite hopeful for. It's actually my only non-dividend payer. Ticker symbol in Toronto on the TSX is SLL, and it's called Standard Lithium, and it's basically a lithium mining play. And obviously my thoughts there are okay. All of these electric vehicles and all the Teslas and all the Rivians and everything. There's going to be a lot of lithium needed for all those EV batteries, right? And I bought it quite low, under $4, and I didn't buy a lot of them. Um, but at one point, it went up to about 13, maybe $14, and right now it's around 6. So I'm still well up on it, and it's kind of one of those ones where I see the potential for it to go really high.
Mm-hmm. Yeah. Yeah, and that's another thing that's really challenging with investing is like I remember I tried to get my dad into investing and he instantly was attracted to like what's the next big thing? Cuz he did start a lot later. Like my dad's 30 years older than me. I'm 28, so he's 58.
Right?
And it's one of those things where he's like, okay, I got to make up for lost time. I have to do some speculative stuff, some like high growth. Like he wasn't super into dividends, and if he was, it was the higher yields and stuff like that.
Yeah.
And his big thing, this was like during COVID, and like COVID lasted forever, but like during 2020, 2021, when everything was going up, and he was buying a lot of the EV stuff. He was buying a lot of the cannabis stuff. He was buying like a lot of the gene editing stuff. He was buying a lot of that stuff because that was all stuff that was going on at
Yeah.
the time. And I'm like, man, like those are all hype trains. Now, I do think the one that is going to last and be sustainable is the EV plays out of that. And not to
Right.
say that, gene editing and stuff like that's not going to be big, but like the amount, I don't know if that'll be big enough by the time he would need that money. And I don't even know if he still holds the positions, to be honest.
Yeah.
But yeah, it's really hard to do that too, because like you can have all the like even all the I don't know how much you watch like TV with stocks and stuff like that, but you'll have one guy come on 1 hour and he tells you the world's gonna crash and we're gonna the S&P 500's going to 2 cents, and then the next guy comes on and he goes, I think it's going to 10,000 in the next 6 months,
Yeah.
and you're just like, all right, well, like, and the
Well, one
craziest
of you
thing,
was definitely wrong.
yeah,
Right?
one of them's for sure wrong, if not both of them, and the hardest thing is like they both come with like studies, and
Valid
this is what
points,
the
and
yeah
yeah.
like this is what history says, and if you look at this number and look at, and that's why I made my investing strategy so simple, is because what somebody says is like PE ratio is the easiest one I can give the example of. Everybody is like, oh, you want to that's expensive for that company, the PE ratio is there, it's here for the sector or whatever. One PE ratio for each individual company is very different, because like some like I own Costco is notoriously always expensive, but Costco, I bought it 2 months ago and I'm up 11%, and it just always goes like always going up. Like it never goes down.
Yeah.
I bought it at like $4.95 and now it's worth like $5.50 2 months later. So it's one of those things. And again, I dollar cost average every day, so my cost basis keeps going up, but it's fine. But like they come with so many stats and things, and they're like, oh, PE ratio is this, but like certain companies you pay the premium for. And then other company, like certain sectors, the PE ratio is higher than on other sectors. Like tech is one of those where like the PE ratio for tech stocks is always higher than like utilities or your communications. Like those are lower. So I don't know. I tried to get rid of all that stuff. Here's some simple stuff that I understand, and I just follow that stuff. And not to say it's right or wrong, but it's worked so far. But yeah.
Couple of points there that I'm going to come back with. You mentioned cannabis stocks, and as I was mentioning, I was going through my entire portfolio this morning, and I own one called HMMJ, Horizon Medical Marijuana, I believe, or something like that. And it's one of my few ETFs, but it is by far my biggest loser. I'm down like I
Yeah.
think over 80% on it, like
Well, and it's when you bought it too.
ridiculous. Yeah, it was. Obviously when marijuana became legal in Canada, there was just tons of companies that became listed on the TSX, and they all went crazy for a few years. And yeah, there's been quite the marijuana crash here in the last year or two. This one does pay a quarterly dividend, and I get like $1, maybe $1.10 from it. So I've joked that like, yeah, I only need to hold it for 500 years to break even.
Well, so when you have those positions, and if you are still in the spirit of not selling, because we were just talking about that, do you identify, or do you recognize that you identified that holding, or in this case an ETF, for a reason, and do you double down and say, I'm going to hyper aggressively invest in this to get my cost basis down to mitigate those losses, and then if it ever does rebound to anywhere close to where it was, then it's a winner for you? Or how do you handle that?
So not so much right now. I've definitely thought about that strategy for sure because it's a very valid strategy to do exactly that. Um, but because I'm so focused on those other three companies I was mentioning, dollar cost averaging into this year, the Bell Canada, the Bank of Nova Scotia, and the Hydro One, I just really haven't looked at putting funds towards that. Um, a lot of the ones that I am down on, and even if it's a REIT that I'm just down on a little bit because of, like I said, the high interest rates, and that I believe in long term, I'm not going to sell them. I'm just going to like let them sit. Dividend is going to keep coming in monthly or quarterly, and that dividend just keeps coming in whether the stock price is up or down. Sure, there's obviously always potential for a dividend cut.
Mhm.
Um, of course, there's always potential for a dividend raise as well if the company identifies that it's doing well. So, that's my answer to that is as of right now, no. But yeah, I've definitely considered that strategy.
Yeah. I mean, it's goes back to what we were saying earlier about like tracking stuff. Like on my spreadsheet that I track, I have my cost basis. And sometimes, buying, $6, $10 of a stock each day, like you don't see a lot of movement. But like even like I always try to find something that gets me excited about each stock when I buy it every day. And when it's a company that's going up, I literally have said that before where I bought a company. I'm like, crap, like Apple's now 2% more expensive than it was yesterday. And here I am buying it. But like in the long haul, especially when you dollar cost average every day, I'm getting the average price of Apple over the last however long I hold it. So that's really cool with that. But what I'm saying about the tracking for you with the dollar cost averaging, instead of like a good mindset trick for you would be like right now you're focusing on the projected annual dividend income and stuff like that. With that one, you can be like, okay, this one's not going to add a lot to my projected annual dividend income, but I know if I add $50 or $100 to this, my old cost basis was this, and then you'll see it drop a lot just by adding that little bit of money. Like that, those are the small wins I try to set myself up with, because like we both said, dividend investing is such a long journey that if I can find any way to manipulate my mindset to be like, oh, here's a small win,
Yeah.
I do that. And I'm just like, okay, like NextEra Energy is one that I own, a big energy company in the United States. And it's one of my only losers to this point, and it's down. So I was like, okay, if I buy $50 right now instead of $7 over the next couple of days, if I buy 50 right now, it's way below my cost basis. And then I just watch the cost basis drop by like 50 cents a share. And I was like, that's a win. Like that's now when it goes back up to 77 instead of 71, Now I'm going to be getting whatever 73.50 per share instead of 74, like something like that. And you're just like, okay, like you have to buy them when they're down, because if you buy them when they're up, then the same thing happens with the stock that you had in the beginning when it was all hyped and everything else. Eventually,
Yeah.
somebody's going to get caught holding the bag, and in this
Yeah.
case, it sounds like it was you, because that's how
Yeah.
luck
On
works.
that one, definitely. With that said, my overall portfolio, I'm still up. So I do have quite a few winners. Just I don't have any winners that are up at that, you know, equal 82% to offset the loss of that 82%
Yeah,
down. I don't have anything that high, but over my entire portfolio, yeah, I'm up. So I'm
yeah.
happy overall. And like I said, the dividends keep rolling in either way. So
Yeah. Yeah, and that's another cool thing about the dividends is like no matter what, up, down, sideways, and different, like you're gonna get the passive income provided they don't cut it. And it like there's no right or wrong way to think about that either, because like a lot of people say like, why are you adding money to your losers, and then other people will be like, oh, why are you buying stocks when they're at an all time high or what? So it's, to each their own. Like there's
yeah.
you're gonna make somebody upset, especially on the internet. You're gonna make somebody upset all the time. Like that's how it works. But okay, so that's actually goes really good into the next question I have. So, do you have any dividend milestones or achievements, and what role do they play in keeping you motivated during this long journey?
Yeah, so that's a great question, and it kinda actually I wanted to circle back to your dad at age 58, and like I said earlier, I'm 50, so him and I are pretty close to this same age group, and, looking at dividends being, a long-term investing goal, but then we're also looking at, like, life expectancy and life cycles is like, well, do I have 20, 30, 35, 40 more years? Because you do the math at 50 and you're like, "Oh, well, in 30 years, I'm gonna be 80," and not everybody lives to be 80,
Yeah.
right? And in 40 years, I would be 90, and very few people or a lot less people live to be 90.
Yeah.
Um, and then you're also thinking, okay, well, I've been slugging it out now for 35 years or more since I was 15 years old with a part-time job in high school, and then obviously a full-time jobs ever since after college. And you're like, at some point here, we want to retire, right? Like that's the goal of being, you know, financially free, time freedom, and everything, so that you are able to enjoy retirement. And whether you're able to retire at 55 or 60 or even the stereotypical 65, you need to have more than just what the social security. Believe in the US you call it social security.
Hmm.
In Canada we have two things. One's called the CPP, which is the Canada Pension Plan, and the second one is OAS, which is called Old Age Security. But you add the 2 of those together, and they are not enough to pay your monthly bills,
Hmm.
right? Especially with the way inflation's gone in the last couple of years. So, you really need to have something on top of those 2 things, and that's what I'm really focusing on, in 10 years, to just have my dividends be enough to be able to cover all of my bills. And if I decide to retire at 60 and begin drawing, at 60, you can draw on your CPP, your Canada Pension Plan, but it's drawing early, so you're
Hmm.
drawing less per month than if you worked until you're 65. But the point is, if you have enough in passive income from other sources, then it doesn't matter. I've also said this in the past too, is that those those government vehicles should be your bonus money when you're
Yep.
retired. They shouldn't be what you depend on. They should be the money that you use to you kind of like be able to treat yourself
Hmm.
or do whatever. And your nest egg of whether you have a dividend portfolio or if you're a total growth strategy person, or if you have physical real estate, whatever it is that's gotten you to the point that you can retire, you need to be able to have that as your main source of income when you retire, and use the old age security and the CPP as your um, like I said, as your bonus money, maybe a little bit of a safety net or something, but you definitely cannot depend on those 2 things alone. So,
Well, how cool would it
um,
be to have it where your dividend income supports your monthly expenses, and then you still, like in your case, you could wait to draw until the end of when you
right.
have to draw that, and then you get more money, and then you can use that money to build the dividend income that you're already able to live off of. Like, how cool would
Yeah,
that be? Because it doesn't matter
that
what you
that
put that money towards. So
that
why
would be
not use
good.
that free money that you don't necessarily need, but you can use that to make more money that
Oh,
you're
it's
not going
not
to
free
need.
money. I've been paying into
Yeah,
it my
oh,
whole
yeah.
life.
It's your money. It's your money. But yeah, so I've been thinking that same thing. That's kind of my strategy is I want to retire at 50. I have 22 years to do that, and I want to retire just off my dividend account. And then at 59 and a half, I get my 401k and my Roth IRA. And
Right.
then I think it's 67 is at or it might be 70. At 70, I'm going to draw off Social Security and get the max I can get from there. But if I was already able to make it from 50 to 70 without needing that, I don't plan to need it at 70, and I can just use that to grow my income and my accounts. So it's very similar to what you're saying. So I mean, if you can get your dividends to pay your income, then when you do draw off of those two programs that you have up in Canada, like you can just use that to increase the money that you're already able to live off of, which is really cool.
Yeah, that's a great point. I'm
Yeah.
going to do that.
Yeah, that's I mean, and like you're already able to do it. Like, why not use I mean, you've already been doing it to get to this point anyway. Like, you already been putting money in to make you more money. So
Yeah.
why not take the money that the Canada gave you and put it back in and make you more money?
Yeah, exactly.
That's cool.
I'm going to talk about another stream of income that is definitely not passive income, and I know you and I are both striving to get there, but is YouTube.
Mhm.
And that's another obviously can be a great source of income. You see these bigger channels with a million or tens of millions of subscribers, and you see that they're spending a lot of money on their videos. So it's like, well, that money's coming from somewhere.
Mhm.
Or obviously, Mr. Beast, the prime example of what's he up to now? 165 million
I
subscribers
feel
or
like he
more.
has like 2 subscribers for every person that's on Earth. Like,
Yeah, right.
like, I don't know.
Everybody on Earth has two YouTube channels,
Yeah.
and they're subscribed from both.
Yeah.
But he's a prime example too of how much money is possible to make from YouTube. And so yeah, that's another thing that I'm really hoping in the next 10 years that I'm able to grow the passive income podcast to a point where I have a little bit of a side hustle from YouTube that I'm either able to invest more of that into my portfolio of my dividend investing portfolio, or um, use that to pay bills or whatever. Maybe even if it gets to the point to replace my 9 to 5 type
Mhm.
job, and it becomes my full-time job. That's kind of the dream. I just need 100,000 more of you to subscribe to the
Yeah.
Passive Income
Yeah.
Podcast.
Yeah. No pressure. Thank you.
And watch all the videos
Yeah.
and click like and subscribe,
Yeah,
right?
in full. Don't watch 10% of it. Like, we need full attention.
Yeah.
But yeah, that's the cool thing about like this show and your show is like, it's not. I mean, we do it obviously right here as video, but like it's more of an audio thing. So I tell people all the time, I'm like, yeah, whether it's a 45-minute show or a 2-hour show, like while you're mowing the grass or while you're going to get groceries, just pop a headphone in and you can expand your knowledge of learning from mistakes or learning, oh, maybe I should look into this company or that company, or
Right.
maybe look for my stocks this way instead of the way I've been doing it. Like, it's a good way to learn,
For
and
sure.
make use of the time that you're going to be doing something anyway, and you don't need to watch anything. You can keep your phone in your pocket and you can listen to both shows. So,
Like I said, too, I've learned so much just from talking to people. Like,
yep.
I'm in a great position where I've now talked to 90 different people and heard 90 different stories, and ranging in age from as young as 18 up to the age of, I'm not sure how old the oldest people have been, but I'm guessing into their 70s, right? So, um, and every age group in between. So you can just imagine
Mm-hmm.
how many different, uh, you know, stories and lessons I've learned, and like, learning from other people's mistakes, learning from and celebrating their successes. It's just been uh, absolutely amazing. I am going to kind of make that point too about YouTube not being passive income. It bothers me so much when I see people on Twitter say they'll like put a list of things that are passive income and they'll include YouTube in there, and I'm like, if you think YouTube is passive income, you've never done YouTube
Yeah.
because
No.
YouTube is a lot of work.
It maybe eventually, like if you get to the point where you're monetized and you post a video a month or something like that, and you're not even making a lot of money off the video you just posted as much as you're making off of the old videos that you've made at that point. But it's the
Maybe.
same as like writing an ebook. Like, that's considered passive income, but you still had to write the book in the beginning. Versus like dividend investing, I consider truly passive because like it takes me as little as a second to buy a little bit of an Apple stock, and then
Yeah.
I never do anything with it ever again, and it pays me forever. So I mean, I don't know. I mean, I think it could be. I think when people do that like list of passive income things, I think they really need to do a tiered list because there's levels to passive income, and
Right.
certain ones are immediately passive and certain ones become passive, and then certain ones are passive but sometimes active, like owning real estate. It's
Right.
passive when you just sit back and collect it, but like say the person that was in your house vandalized it or whatever, you got to fix it up. It's no longer passive, or they call you at 2 a.m. because their air conditioner broke, or like it's passive until it's not. So I
Yeah.
think I think there's levels about it. So do you have those milestones or achievements that you've reached, and like pointing at, like, maybe do you have one that you'd be willing to share where you looked at it, you have that milestone that you achieved, and it's really like boosted your motivation level to like keep going?
Uh, regarding regarding YouTube, regarding
No,
Twitter, regarding
sorry, just the
investing.
dividends. Like, have you looked at one and like you get that one really big thing, or when you're tracking your accounts and you see the year over year growth of what you made last year was maybe $150, now you made $300 or something like that.
Yeah.
Have you had a moment where like that, where you're like, maybe you're like, man, dividends are really slow, I'm not really feeling it or whatever, like less motivated, because everybody goes through those, especially with a long journey like this. And then
Yeah.
you get
Yeah.
that one thing where you're just like, man, I'm doubling down. Like, this is where it's at.
Actually, just this month, July, I noticed in June that my monthly my month of June was kind of lower, a lower total. But then I kind of looked and I'm like, oh wow, I have a lot of quarterlies coming in July, and a lot of those are again going back to those three companies that I've been really focusing on increasing my shares this year. And so yeah, basically from 3 months ago, in would it be April that they would have paid out last?
Mhm.
Yeah, so, like, that Bell Canada, I've pretty much doubled my dividends, and it's still, like, small. It went from, in May, I think $11 and change up to, $20 and change in July. But right away with what I had, just yesterday, I bought 3 more shares, so when they pay again in October, I believe,
Mhm.
um, I probably won't double again. I won't go up to $40, but so yeah, just those little wins mean a lot when you can see that growth, even just within a 3 month time frame where you went from $11 dividend to $20 dividend, whereas by October it should be in that maybe 35 range, maybe higher. So um, yeah, just really focusing on that, I guess.
Well,
Sorry, what was
those are
your
the
question
small
again?
wins. Those are the small wins that you like. You have to put it in a different perspective for like regular people to understand. Is like, if you were making $11 an hour at work, and then all of a sudden in 3 months they were like, here's $20 an hour at work, you wouldn't be like, oh, that's nothing. Like, because
Yeah,
you have to figure, one, that's active income that you're getting, and you'd be really excited about a $9 raise.
yeah.
Dave just went from $11 to $20 in a quarter, and it's passive, where he's going to make that barring a dividend cut, but also
They're
not
not cutting anytime soon. They
yeah,
just
yeah,
raised back in January,
yeah,
so I'm
barring a
expecting
cut.
them to raise again in next January.
Exactly. Barring a cut and not including a raise, he's going to make that $20 a month. And he's already, bought more shares. So he's
A
going to make
quarter,
more than
20 a
that. Yeah,
quarter.
20 a quarter. Yeah, 20 a quarter. He's going to make that every quarter from now on. And that's barring cuts or raises in the whole time, or adding new shares. So, like, that's super, like, that's stable income that he's going to get, and he doesn't have to work for it. So,
No, literally every 2 weeks, I pick up my phone on my lunch break and go click, 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 click,
yeah.
and
And
there
now
you
it's
go.
$22, and then it's
Yeah.
$24. And you just,
Well,
little.
even since that last ex-dividend date, I believe I have maybe 6 more shares, and it's nearly a dollar, I think it's like 97 cents per share
Mhm.
per quarter, so something like that, maybe 98 cents per share per quarter, so,
Yeah.
um, yeah, it's obviously, getting to that point where it's adding up. Um, yeah, and I actually still have more dividends coming in July, so, I think my total for July will be about $180, maybe give or take,
Very
so,
nice. Yeah,
yeah.
July is my 14710, which my birthday is in October, so that of course that's my lowest one of my lowest months. But I only have one payer in those months, which is annoying. I actually made two portfolios that like have you getting paid weekly. I own a couple stocks from each of those, but I only have one payer in those months. So this is my boring month, but I have enough stuff to track, so I make it fun enough
Right.
that the recap videos are good. Okay, so we're getting close to being out of questions here. So next one. This is actually, I'm really interested to hear your opinion on this. How or when do you know when you'll have, like, when is enough enough? Because like what we know in dividend investing is compounding is beautiful, right?
Right.
So 1 year you could have, like, say you get to the point where you're 60 years old and your dividends are generating $60,000 a year in dividend income. But what happens if you say, I want to retire? Like, what if you made it a goal to retire by 60? And then at 61, because of,
That is my goal. 10
yeah,
more years
yeah. So you
or
have
less, hopefully.
so, okay. So this is going to be a really good question for you. You're going to,
Unless the passive income podcast gets 100,000 subscribers, I will do that forever because I love talking to people about this, right?
yeah, that was okay. So there you, so this is a perfect question for you then, because this is something I struggle with. You're going to get to 60. You're going to make $60,000 a year. I don't know if that's your goal or not, but let's just say $60,000 a year in
That's a
passive
fair
income.
number. Yeah.
If you wait till 61, you could make $72,000 a year in passive income. And if you waited till 62, you could make 80, or just say $90,000 a year, because that's how compounding works. It's faster and
Yeah.
faster and more aggressive. So like, how, like, is there going to be a point where you're like, okay, I'm now 62. I worked a little bit longer, but now I added $40,000 in just those
Right.
last 2 years. Like, how do you know when enough is enough?
I don't know how to answer that because you never know.
I agree. I'm in the same boat because I'm competitive and I'm like, man, if I just wait one more year, it's going to make me $12,000 extra.
That's a very great question, but so difficult to answer. Because again, obviously, I'm going to circle back to your dad and our age group. We want to retire. We've been doing this long enough now. We've been slugging it out for, like I said, 35. Your dad over 40 years at his age, and we're ready to pack it in. And but it's like, oh, but I'm looking at my finances and my my those monthly bills keep coming
Mhm.
whether you're working or not, right?
Yep.
So you need a way to pay for your cell phone, your internet, your you got to keep the lights on, the hydro, um, the mortgage, the insurance, the gas, the groceries. Obviously, all of those bills add up, and you need a way to pay for them every month. And so, yeah, it really goes back to how successful I become on YouTube because, like I said, I don't want to keep going back to that same day job. Monday to Friday, I actually work 8 to 4:30, but it's your typical 9 to 5 type you know scenario. And so, if in 10 years I have enough to call it quits and retire from that, yeah, I would probably do that in a heartbeat and be satisfied with the 60 per year, because 60 per year would cover my bills, right? So I'm okay with that. Um, but like really, in all honesty, I'm really striving to make the passive income podcast more successful on YouTube, so I have that opportunity to maybe walk away from that 9 to 5 in 5 years time,
Yeah.
and then do the podcast, just keep talking to people for another 10, 15 years till I'm 65 or 70, and let YouTube keep paying me.
Yeah.
So there's we don't know the future. You can't, that's another reason why this question is impossible to answer, is because who knows what the future is going to bring.
Mhm. Yeah. I know, like I said, I'm competitive, or if you want to call it greedy, like that's going to be a thing that I have where like right now it's really hard to predict, 20 years in the future as far as like
Right.
what my income will be, cuz hopefully I make more from my day job and then I can add more, and hopefully my expenses don't, all kinds of stuff like that. So predicting stuff like that's very, very difficult in general. And the further you get away from today, the less
Yeah.
likely it is to be accurate. But it's one of those things, man, where I'm just like, if I can wait one more year, you're like, yeah, I wanted to retire at 50, but if I wait till 51, I can go from
Yeah.
having 60 grand a year to 80 grand a year. I'm like, that's worth it. One more year for 20 grand for like
Yeah.
ever. I'm like, why would I not do that? So
Yeah. Yeah.
it's just something I know I'm gonna struggle with. So I always like to ask the people that I talk to just to see.
Yeah. Kind of a follow up to that too. not knowing what the future holds. We know right now interest rates are high, um, and you know, my mortgage comes up for renewal in, I think it's 3 years. I just bought this house, yeah, 2 years ago, so it's, so if in 3 years' time, if those interest rates haven't gone back down, then I'm probably going to have to seriously think about selling, so that my monthly mortgage payments don't go up. And at that point, I would think about obviously downsizing. I could get a pretty nice chunk of change for this house. I could obviously pay off the mortgage, and then I could move anywhere in Canada, and there's a lot of places in Canada where real estate is, much less expensive than what's advertised. We hear all the time in the news about how ridiculously expensive real estate is in Toronto and Vancouver and the major urban centers, but there's a lot of places in Canada that I'd be more than willing to live,
Yeah.
like, in very rural areas, that are very nice, and rural areas tend to be very friendly people and all of that, and you can still have everything you want, but you can, like, literally get and from what I would make from selling this house, I could buy a house mortgage free in some of these
Yeah.
less expensive areas. So
Yeah. Well, yeah, like that's a big realization by you is like a lot of people always try to figure out ways to make more income to increase their income, and sometimes it's as simple as reducing your expenses.
yeah,
You can make the same amount, but if you can go from paying $1,000 a month for a mortgage down to $600 a month,
or
you're
to zero.
yeah, or to zero, like that's just a big. Most people, your mortgage is your biggest expense. So if you can figure out a way to reduce that, or like I refinanced during COVID, I had a 4.625 interest rate before COVID, and now I have a 2.75% interest rate,
Right.
and it's a locked here. We can lock in for 30 years, so I'm locked for 2.75, which is
Oh,
basically free money.
yeah.
Like
That's
that's lower than inflation is right now. So,
yeah,
um,
by a lot.
yeah, so it's we're doing really good there. So I haven't heard this in any of your conversations so far. So, do you have specific criteria that you use that you like run a checklist through your stocks when selecting your stocks, or do you just like what do you use to identify the stocks that you're going to invest in?
So a lot of those early ones that I bought, like I said, they were the REITs, they were the monthly dividend payers, and I bought a lot of those, really not knowing what I was doing, just looking at it, going, "Oh, it pays a monthly dividend. Oh, it pays a nice yield, and
Yep.
I'm going to make this much a month. Okay, I'm going to buy whatever it is, 10, 50, 100 shares of this company." And so in the beginning, there was like next to nothing other than, "Yep, I've got that in my account. Yep, they pay a nice dividend. Yep, it's a monthly payer. Click buy."
Yeah.
Okay,
Yep.
so um, highly recommend not doing it that way.
Don't do that. Yeah.
And luckily, like I said, I don't really feel like those are mistakes because those dividends still keep coming in every month. I'm not adding to those positions, but at the same time, I'm not selling them because they're just sitting there, and I still get whatever it is, whether it's 5 or 9 or $8 or $12 every month from them. I'm like, okay, I'll take it, right?
Yeah.
So
I guess if I have to take your $10, if I
yeah.
must.
So yeah, no. Basically, what kind of opened my eyes was my conversation with Dividend John, at Johnny Boy. I think it's 1835 on Twitter, and he was on back on my show back in December, and he really hammered home, dividend growth and how important that is in focusing on your overall strategy and looking at companies that grow their dividend every year.
Mhm.
And so since then, I've, yeah, definitely been more focused on dividend growth and dividend yield.
Yeah, that's really good. And like those are the that's what I was saying about it doesn't have to be complicated. Like you find a dividend growth rate that you prefer and you're like, okay, one of you don't even have to have 50 filters. You can have two filters. Like your filters are
Yeah,
do they pay a dividend, and maybe does it have a dividend growth rate, let's just say over the last 5 years, of more than 5%. Like those are your goal. And,
yeah,
or you could set it out further, like 10 years average of 5%, that's good. Like that shows longevity and that shows that they're paying 5%, which, generally would beat inflation. Right now, maybe not.
right.
But because my three are dividend streak of 5 or more years, a dividend growth rate of 3, 5, and 10 years above 10%, and then it outperforms the S&P 500. That's all. Like those are base.
Yeah,
And
yeah,
I add one more that's like kind of in there. Now, like you said, as you've grown as an investor, you've like learned different things to care about. My other one's like a payout ratio. I'd like to keep it like below 40% if I could, because I like that dividend growth, and they can't keep growing their dividend at the pace I do if their payout ratio is too high. So it's kind of one of those things that I've like thrown in there.
So you mentioned longevity. The Bank
Well,
of Nova
Canada's the
Scotia.
king of longevity. You guys got stuff that's paid for 200 years or something.
That's the point I was just going to make.
Yeah.
Bank of Nova Scotia has been paying a dividend since 1832 or 33.
Yeah, I
So it's
remember that
coming up on a
when it
200-year
first started.
anniversary.
I remember them starting their dividend back in 18 something
Yeah,
something.
yeah, you recall
Yeah,
that, do you?
yeah. I think I can. It's a little hazy, but I think I remember that. Yeah,
Yeah.
that's ridiculous. Like but
Like
that's not.
you literally had to ride your horse to the bank,
Yeah,
right?
yeah, yeah, yeah.
Like, not even joking about that. You rode your horse to the bank.
Yeah, that's insane. So, but if my memory's right, those aren't like that's longevity as far as like at least paying a dividend. Do you know
Yeah,
Canada's
yeah.
longest like paying and growing?
Uh, I think it's one of the energy companies, and I'm not sure if it's it might be Enbridge. It, I don't think it's Suncor. Somebody comment it below. I know there's one that's over 50 years of dividend growth.
Yeah.
But yeah, the banks are just longevity. Obviously, they haven't been able to raise their dividend every single year for nearly 200 years, right? Like
They'd be paying out
that
$300 a quarter in
yeah, right.
dividends.
Like that's
Yeah.
just well, I'm sure that first dividend back in 1833, actually Bank of Montreal was the first one in 1829, so they're even closer to it to their 200-year anniversary. But I'm sure that first dividend couldn't have been much like like maybe a fraction of a penny.
Yeah.
Like
Well, that's what so Realty Income, everybody talks about it. I don't own it, but Realty Income monthly dividend payer, and they increase their dividend every quarter, which is really cool.
right,
It's cool to say. Over the year, like it still does average out the 2% or whatever it is, but they literally will be at like 0.2555 of a dividend, and then they'll raise it to 2.255 or 256. So
right.
it like literally a tenth of a penny and
Yeah,
they do that, which technically they're not wrong. They are raising their dividend, but like unless you own a
very incrementally. Yeah,
yeah, unless like good luck finding a tenth of a penny somewhere and like spending it. It's like,
yeah,
hey, this is more than you had. Like I don't know. So it's one of those things where it's cool. They're known at it at this point as one, the monthly payer, but like also the quarterly increaser. So like that they're playing to it. But yeah, that's really cool. I'd be curious. I might look it up after this talk to see what Canada's longest paying and growing is, because I think in the U.S. ours is, I don't remember who it is, but I think it's 67 years of paying and
right.
growing. Because obviously we have the kings and aristocrats and stuff. So,
Yeah.
okay, another one. How important is staying diversified, and what rules do you help set with that?
Yeah, that's a great question. So, I love diversification. Um, so I have talked a lot about REITs. I really, even though they're getting hammered, like I said, because of interest rates, so their pricing is down. But that's actual physical real estate that they own. So, REITs. I mentioned Bell Canada, Telecom. I mentioned the Canadian banks. Um, so right there, just diversified in three main sectors. I do have some in the energy and oil and gas sectors, and I think I've done quite well with diversification, even though I only have something like 24, maybe 25 total positions. Um, that one non-dividend payer I spoke about, Standard Lithium, a little bit in the mining sector, not very much there. Um, I also have more consumer discretionary in just a few food companies. So one is called Pizza, and obviously here in Canada we have Pizza Hut and Domino's and other pizza chains, but Pizza is a nice little monthly dividend payer, and it's actually one of my bigger positions. I think I'm getting over $20 a month, and they just raised their dividend as well, so that's nice. I'll take that $20 a month all day long.
Mm-hmm.
Um, Another one called SRV.UN, and it's more it owns like a different chains of restaurants, and so again, it's a monthly payer. I think it's 12 or $11 a month in that one. So again, that adds up 20 plus 11, you're up to 31 a month.
Mm-hmm.
That's nice. I'll take it. I own one called Rogers Sugar, which is they are very big in Western Canada. They're in every single grocery store in Western Canada. You would find Rogers Sugar, and they're a quarterly dividend payer. And honestly, that's one I kind of forget that I hold until every 3 months it shows up in my account. I'm like, oh yeah, thanks for giving me money to not even think about you, right?
Yeah. That's that. So like, do you have do you set like sector limits on like how much of your portfolio is it stock by stock, or do you just buy, make sure you're split up somehow evenly, or how do you do that?
So I'm not split up evenly, and I am trying to figure out a way to get things a little more even. My biggest position is called RioCan, which is a REIT, and it's a very large REIT here in Canada that holds several, like a lot of retail, holds some industrial, and is trying to expand their residential real estate as well. Um, and it was like around 20% or 19.5% of my portfolio. And but just the other day, I'm like, the price is below $20. I'm just gonna buy 5 more
Yeah.
shares.
Yeah.
So even though it was already my biggest position, I'm still too tempted not to add to it, right?
Yeah.
But I am trying to yeah, even it out more across the board, and even it out more throughout the different sectors that I have.
So if I can give you homework, last week my interview with Kenyon, listen to that again. You don't have to watch it. Just listen to that interview.
Yeah.
He had a very interesting take on diversification that like really made me think about like how I want to approach it going forward. Because like
Well,
that
and
is, go ahead.
how important or not as important as some people make it out to be, because there's definitely a thing of over diversification
Yep.
as well, right?
Yep. Yeah. Yeah. He had a really, because there's some people that I know that'll have 100 stocks, and that, they have a hard limit of, I don't have any of them above 1% or whatever.
Yeah.
And I know the typical thing is I think you don't want 20% or more in one sector, and you don't want 5% or more in one stock, but I only have 11 stocks. I literally can't
Yeah.
can't do that. And there's, I think, two sectors that I don't own, which is communications and real estate. Communications here, I don't like any, like AT&T and Verizon. They're well known, but they're not. I don't think they're good companies to invest in because they just have
Right.
too much debt and they lose you money. And then with real estate, it's my taxable account, and I don't need the frequency of income yet, so I'm not worried about it. Like once I get closer to my goal, then I'm like, okay, like let's maybe start throwing some monthlies in there or whatever.
Sure.
But yeah, so that's, listen to that interview. He had a like you said, every interview you do, there's always some kind of takeaway for you or somebody else, and that was
Yep.
one where I was like, man, like he brings up a lot of really good points on diversification. So that's a really good listen. Okay, so I think two more questions. I don't want to take too much more of your time. So this one will be fun. What are there any dividend myths or misconceptions that you hear all the time that just drive you insane and you want to prove wrong? Like not prove wrong, but like you want to tell them like why this isn't true.
No, not so much, and I'll tell you why. Because I see it all the time between two people on Twitter, or well, 3 or 4 different people on Twitter going back and forth between dividend investing and total growth strategy, and both sides make very valid points. And so it's like I'm like the peanut gallery on that one, where I just love reading the tweets, but for the most part try to stay out of them. I generally don't add too much to those chains or tweet threads. Are we still allowed to call them threads?
I don't. Yeah, I don't. Yeah, I don't know. That's a good question. Yeah.
So yeah, like I said, I
They're
generally stay
branches
out of
now.
them.
They're
Pardon me?
they're tweet branches because it's
Yeah,
Twitter
tweet
for
branches. Yeah.
there you go.
So I do enjoy reading them because, like I said, both sides make very valid points. But I I'm trying not to have an opinion on it, basically.
Yeah. There's just common ones that I always hear about, like dividend investing is only for old people. Like they're like, oh, when you're retired, you get into dividend investing. I'm like, I feel like that's the opposite. I feel like
Yeah.
if you could get in at 18, like that would be best.
The
And
more you build,
then
the earlier you build, the
yeah,
better it is.
yeah. There's so many that I hear all the time, and I'm just like, I don't know where you're getting. Like they say dividend investing doesn't work. I'm like, you could argue that dividend investing done over a long period of time is almost guaranteed to work.
Yeah.
Like as long as you stick with it. And a lot of people will say this.
Ask Warren Buffett if dividends
Yeah,
have done
yeah.
okay over 70 years,
Yeah,
right?
exactly. Like Warren Buffett's done it for so unreasonably long that it's like he couldn't mess it up if he tried. Like he literally, it's foolproof at this point. Where he's like, his company Berkshire Hathaway doesn't pay a dividend, but he's getting millions of dollars every quarter from Coca-Cola to the point where
Yeah.
he just
Hundreds of millions, I
yeah.
thought, if I'm
Yeah,
not
I'm just like,
mistaken.
what? Like, and then he's like, oh, I don't like dividends. I'm like, slide it over here, Warren. Like, I'll take it.
Yeah.
Like, I don't want to. If you don't want it, I wouldn't want to burden you with hundreds of millions of dollars.
Yeah.
Yeah, that's ridiculous. Okay, so last question for you. What? Give me your tips for someone that has decided to begin their dividend journey today. So that it can't be the obligatory just get started. They've already decided that. Like, what other tips do you have for them?
Yeah, just get on base, which is the just get started part.
Mhm.
Just get on base no matter what. You just, get hit by a pitch, bases on balls, ground rule double, just get on base. So that's the just get started part. Like you mentioned, that answer doesn't count, but you do have to get started. Um, Pay yourself first, as I mentioned near the top. Pay yourself first every single paycheck, every 2 weeks or every week, whenever you get paid, whether it's 10%, 15%, $25, any of those amounts, $50, any of those amounts I just mentioned, whether it's a percentage or a dollar amount, is a lot more than zero,
Mhm.
way more than zero, right? So, and then I have kind of my three keys to to investing in general, whether it's the dividend strategy or the total growth strategy. Um, Patience, consistency, discipline. So the patience to know that you're in the long game for 15, 20, 25 years, the consistency to pay yourself first every 2 weeks or every paycheck, and the discipline to have the patience and the consistency.
Yeah. Yeah, that's exactly right. Yeah, it's you just tweeted that recently, right?
I've tweeted it a few times
Yeah,
now.
I just saw because I am not on Twitter as much as I'd like to be, but I saw that the other day and I was like, that's it's very true. Like I was saying earlier about like the time, the money, and the wisdom. Like you never have all three at the same time. They come and go as life passes, but like you have to take advantage of which one you have and understand how to capitalize them. When you're young, you have the most time. How can you? That's when you learn. That's when you get education. Like there's a difference between
Right.
knowledge and knowledge and wisdom too. Wisdom is trial and error. Like you're getting to the point where in your dividend journey where you have the wisdom. You have knowledge about
Oh,
dividends, but like you've
oh, I'm
done
long in the
things.
tooth. Yeah.
Yeah, you've had all these things where like, okay, I know this, but I also know what led me to this decision. I know how I recovered from that decision. I know how I persevered and like what I did because of that decision. Like you have
Yeah.
all that stuff that like I might not even have some of that experience yet. I can hear from it, but like it's one of those things like with my dad where he'll tell me something when I was younger and like whatever, like who cares? It's just some
Yeah.
dude talking. And then like when you're 30 and you look back at it, you're like, that's what he meant.
Yeah.
Like
That's what
now
he
it
meant.
makes
Well,
sense.
makes sense
Yeah.
now. Yeah.
Yeah. Like, well, you told me what I didn't need it. Like what, like, I don't, what am I supposed to do with that? I got limited space up in my brain and you're giving me this information I don't need for 20 years. What am I supposed to do with that? But yeah, I think that's a great place to end. I do like your three simple steps. I like your tips. I think this interview was very good for me. I hope you took something out of it.
Yeah,
And
definitely.
you
Very
watching,
good.
I hope that you got something out of it as well. Dave, if you want to give everybody your closing remarks.
Yeah, thank you so much for having me on. Like you said, this has been a great conversation. Really enjoyed it. And make sure to subscribe to Troy's channel is it just at Div Obsession or at Dividend
Yeah,
Obsession
just
on
dividend
YouTube?
obsession. Yep, just hit the
Make sure to hit
subscribe button.
that subscribe button, hit like, share it with all your friends, and definitely check out the Passive Income podcast as well. And Troy, thank you so much for having me on.
Yeah, I appreciate you, Dave. And for everybody that's watching, the Passive Income Podcast will be linked in the description down below the video. So head over there. Dave's had, like he said, 90 guests to this point. So there's got to be something for you to watch in there, whether you like
Definitely.
options, day trading, retired people already that have done it off of dividends, people just getting started. There's something on there for you. And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time, see you.